Hey there, thanks for tuning in. Welcome to Investing in Germany, and today it's time for the weekly market update. We had both the American Central Bank and the European Central Bank both raise the interest rate, and the market was really happy to see the increasing interest rate. This was a bit of a strange for me. So to start with, we had the Fed which increased the interest rate by 25 basis points or 0.25%, which leads to the interest rate to be at around 4.75% at the moment. And whether the Fed will increase the next time is something to be seen, but then the market is already expecting that we are almost close to the peak. I think maybe the Fed might increase by another 0.25% and leave it at 5% for a period of time before they come back and having a look at the inflation data. So let's wait and watch how it really progresses there. But the market was really happy to see this increasing in interest rate. For me, it was a bit of a crazy, strange situation because when the interest rate goes up, the market really comes down because the cost of capital goes up and the company's profits are not really going to meet the same what it used to be when the interest rate was low. But then the market here, you can see that the S&P 500 has gone up by 2%. We have the Nasdaq also gone up by 4%. That's crazy. So what's happening here, right? So one of the main reasons here is also what the market is predicting is going to come in the next months. So you can see the chart here from Nomura where there are some predictions on how the interest rate is going to go in the next years and so on. As you can see here, we are here Jan 2023. Let's say we are somewhere here. Yeah, we already met what the market was expecting, 4.75 here. And then now the market thinks that maybe the Fed will keep it for until the end of this year, last quarter of this year, and then start decreasing the interest rate quite significantly within 1 year back to 0.75. This will not happen for sure because the inflation at the moment is at 6.5% in America, and to bring that to 2% is going to take at least a year or more. I don't think the interest rate can come down so fast. For me, this is a huge speculation by the market, which is also like more or less doing a pump and dump scenario here because now everybody are seeing the market going up and then comes in the FOMO, fear of missing out, and then the retail investor could enter into the market at a really bad time, and then all the speculators and traders, they exit the market, and then the retailers will have a huge dump in our portfolio and we will not be really happy there. So we have to be really careful at this situation. We have to really look at the fundamentals of the company, not the fundamentals of the macro at the moment, because here it's really strange what's happening in the market. So be careful over there. And the employment data also came for this month, and it also proves that the Fed will not decrease the interest rate anytime soon. Because if you see the unemployment rate in USA in Jan 2024, it has even calmed down. So this is not something the Fed would like to have, because the Fed would like to have the unemployment going up, therefore the inflation coming down, and then they can meet the target 2% inflation rate. But if the unemployment keeps coming down, even with the increase in the interest rate, then the Fed will just keep increasing the interest rate until they see at least a shallow recession, because they need a recession to bring down the inflation back to 2%. And we also had several employers within the America where more than 100,000 jobs were cut in January. 41% is coming from the technology firm, even though you don't see it here. But then I think this will just reflect maybe in the next months, because they have a 2 to 3 months of severance period, and then after 3 months, then the unemployment really kicks in. For 2 months, they are really paid. So I think that is not coming here as an unemployment data, but then we have to really keep an eye on that. But what is also interesting to see here is that the manufacturing workers' demand is also increasing here. So the manufacturing activity in the America is slowly inching upwards, which is something that the market is really happy to see, that there is a made in America thing is going on. So the job market is really strong here in America, which will really make a case for the Fed to increase the interest rate much more higher, because they want the unemployment to go up. They want a stress in the economy. They want recession, because 2% target is really a long time to reach. And then we have the ECB, European Central Bank, also increasing the interest rate, this time by 50 basis point or 0.5%. This was more or less clear for us from the last report that they made. And then they also communicated that the next month will be another 0.5% increase in the interest rate, which means that by end of next month, we will have a 3.5% interest rate in the European Union. Whether that is a peak or something that we can't really tell at the moment, but the market is expecting somewhere like 3.75 to 4% is going to be the peak for the European Central Bank. So let's wait and watch. But then as of now, you can really assume that the interest rate in Germany is going to go up. Interest rate in European Union is going to go up. And the market was also happy here for the same reason why the market was happy for the America. So you can see here the stocks Europe 600, which is similar to S&P 500. Here the Europe 600 tracks the top 600 companies within the Europe. And it has also inched up like 2% over this week. But I think for sure that this will correct back to the median. I don't see there is any justification to have an increase in the stock price in the business value when the interest rate is going up. This is all speculations, pump and dump, so be careful over there. A couple of weeks back, there was a lot of noise in America about the debt ceiling level, where it's nothing but how much the government can raise debt to pay their obligations, to pay their bills and so on. So similar actions are now also taking place in the European Union. So European Union, there was a fixed regulation or fixed rule where the countries are not allowed to increase their debt more than 60% of the GDP and also have a fiscal deficit of around 3% of the GDP. So this was something like written on the stone, but then due to the pandemic, it was all removed because all the governments were tight off budget and the whole economy collapsed or closed. Therefore, they were really going out in the market, getting a lot of debt here. And now the European Central Commission has now started to reduce this debt and to bring control and bring some discipline in the debt levels. And this has started now. And as you can see that in 2024 projections, the Italy and Greece will have more than 150% of the GDP. This is an extremely alarming level of debt that these countries are taking, the Italy and the Greece. This is also something related to their economy because they are mostly reliant on those tourist economies. So tourism has not really kicked in even though everything is open. But then we have to really watch how it really progresses because this could have a lot of ripple effect into different economies within the European Union. And we have to see if these countries are able to pay their debt and so on. So this is a really alarming situation within the European Union. And from February 5th, we have the ban in the European Union for the Russian diesel, which I also presented in my earlier videos. So this is coming into effect next week, which means that the diesel price in the Germany should go up because it is a mere demand-supply gap. What you can see here is also that the countries like India, where they are importing the gas or importing the crude from all over the world, they can buy the Russian diesel and use for their own consumption, and then they can refine the non-Russian crude and then sell the non-Russian diesel back to European Union at a much high level. So you can see here almost $40 per barrel is something that they can make profit based on the current situation that we have in the European Union. So what is really good for us at the moment is that they don't see any demand-supply mismatch for the diesel in Germany or at least in the European Union. So the demand and supply is almost there. Only the price will keep increasing at the moment. So keep an eye on your diesel bills there. And then we have some needle moving activities coming in for the GDPR, the General Data Protection Regulation. So when it was going in live in 2018, there was a lot of buzz around the world that European Union is really strict in data protection. They are doing the right and they are really doing something extraordinary and so on and blah, blah, blah. And after that, everything fizzled out. Nothing happened. There was not much of a news, much of a speculation, much of anything about that, right? It looks like there was some process issue over there. So the issue here was that the EU has delegated the jobs to the countries where these big tech companies has been headquartered. For example, here Facebook, which has its European headquarters in Ireland. So if there is a complaint on Facebook on any data issue, data usage issue and so on, then it is the responsibility of the Ireland to impose the fines there. But then this was not really happening because Ireland was really happy to have all the headquarters there. And then they were really earning a lot of money just by having companies having the building over there. But now everything comes into effect where now each countries have to report how they are progressing with all the compliance 6 times a year, which means almost every 2 months there should be a report on showing how it's progressing. So now there's a lot of checkpoints for these governments to really report on how they are progressing with their compliance. Before it was no deadlines, the countries can take a decade to analyze and fine and so on. Now it's going to be really fast and you can expect a lot of fines coming in the next months. The first one has already started. The Facebook, the Meta has been fined like $1 billion euros a couple of months back, and this is all coming into review now. So all the companies will start having their fines coming in for the GDPR. Now everything is getting in a heated mode. Keep an eye on those companies where you are invested in. And finally, Mr. Scholz was on a world tour this week. So just in this week, he was in Argentina discussing and negotiating the hydrogen supply. And also he was in the same week also in Chile to talk about the prospects of lithium, to get access to the lithium available in Chile. And he was also in Brazil on the same week and discuss about the 200 million package for the renewable energy initiatives within the Brazil. So he is really moving away from the China, Russia to South America. He is expanding the supply chain around the world. So he is really going to the South America where there's a rich lithium available, rich energy, everything is available. Now is expanding his supply chain. So I think it's really good to see that. And in the same week, he was again back to Germany, where he was taking part in the joint venture starting between the ZF and the Wall Street to create a chip manufacturing plant in the Germany. This is next to the Intel, which will start their chip manufacturing in Magdeburg. And then we also have Infineon, which has already proposed to start a chip manufacturing plant. And also there is some discussion going on with Northvolt to develop a battery manufacturing facility in Germany. So there's a lot of actions going on to reduce the concentration of supply chain from Russia and China. So Russia is now gone. So the Germany is going beyond China. They're going to South America, where there's a lot of natural resources available. So I think this is really good for the German economy to have a really good widespread supply chain. So let's see how it really progresses in the next months. And thanks for watching. See you in the next video.